How do they get that number? It's voodoo. Kind of. So people buying and selling it drive the cost up or down, right? What else drives the cost up or down? So monetarily, how the company is doing, right? So the company every quarter issues statements, 8K, right? At the end of the year, they issue 10K. They say, here is what we did for the entire year. And people are looking at it, they're measuring it. What else drives price?
Like media, like if there's good stuff or bad.
Perception drives stock price. Ask Budweiser. You remember? You know what I'm talking about? Okay, so that's true. Did anything about Budweiser's operations in their factories actually change during that period? Was it any more expensive or less expensive to produce beer? So why did their share price plummet? Because perception drives price just as much as numbers do. So this measure, this type of ratio, is considered a share price ratio and an industry ratio. So we'll talk about it. These make sense so far? Okay. So these are really small. I'm sorry, I meant to fix that. The general purpose of financial statements and accounting. So really quick, let's talk about this. We talked about an income statement. So on an income statement, I've got revenues and expenses. And that's an oversimplification, right? But we're not building statements in here. So I just need you to know what statement things are on so that when I talk about them, you have an idea of where I'm at. So everybody's okay with an income statement? Do we need to define revenue and expenses? It's okay if we do. I just need to know. No? We good? Okay. So revenue and expenses go on my income statement. My balance sheet, you told me, is my entire accounting equation, right? My assets, what I have. My liabilities, what I owe on what I have. And my equity, what I own of what I have. Yeah? Okay. What goes on my statement of shareholders' equity? Okay, so things like dividends, right? So it is a pictorial showing, right, a demonstration of what's happened to the share price of current owners of that stock over time. So how has the common share price changed? How has the preferred price changed? Right, so it's just demonstrating to you based on what we carry over from period to period, here's how the shareholder has done at a per share level. Make sense? Okay, last one, my cash flow statement, which is one I'm more interested in this class. So I'm very interested in the first two, and I'm interested in this one, not so much this one. So, cash flows, what does it tell me? Take a stab at it. It's in the title. It tells me how my cash flows. Yeah? Why is that different than an income statement?
Because an income statement could include like long-term liabilities and stuff that are not using actual cash, but things like I don't know the word for it.
Okay, so hold that thought for a second. I like a piece of that. I like the not cash part. I don't like the liability part. The liability's not on the balance sheet. But do you remember when we did, as in your 2301 class, or with me, sure, did sales entries, sold $12,000 worth of t-shirts? What did that look like? And you're like, oh God, the journal entries we get. It's just for demonstration. It's okay. Take a breath.
Sales revenue.
Okay, so I have revenue of 12K, yeah? What goes here?
Cost of
Do what?
cost of goods sold.
Okay.
Merchandise inventory.
Okay, you gotta help me out, where'd they go?
Cost of goods sold. Merchandise inventory on the right, the left side.
Okay,
Debit cash. We got.
you told me it's here?
Yeah, cost of goods.
Okay. What goes here?
Receivable.
Okay, so, here's what happened. We sold $12,000 worth of t-shirts that we paid $10,000 for. First note, we're bad at selling. My margin is terrible on that. You agree? You know what I mean when I say margin? We're gonna get there, but okay. So my margin's terrible on this, but I'm waiting for my money. They said, I owe you, great. I get to recognize the revenue, right? I get to recognize the expense associated with generating that revenue, and then I'm going to adjust the asset because I don't have those $10,000 worth of t-shirts anymore. Still with me? So if I'm looking at a balance sheet and an income statement, my balance sheet has my AR on it and my merchandise inventory on it. This has my sales revenue and my cost of goods sold, right? This minus this gives me my gross profit. Problem, where's the cash? That's why a cash flow statement is different than an income statement. An income statement tells me what I've earned, not what I've collected. Does that make sense? So when I collect the cash for this, and I debit cash and credit accounts receivable, my cash on my balance sheet goes up. My accounts receivable goes down, right? Because this always has to be imbalanced. Still with me? To be able to know what actually happened with that cash once I got it, I need this one. Otherwise, I'm like, congratulations, I've collected cash, but I have no idea what the business did with it. So how am I supposed to assess whether they're good with their cash if I can't see what they did with it? Does this make sense? Okay, so I have 4 standards for comparison that I'm going to use throughout the entire semester. One is intra-company. What's intra-company mean? Intrastate?
Within the company.
Within the company, right? So I could be comparing departments within the company. So I usually like to use a department store in this class because everyone's fairly familiar with a department store. Like everyone's been in like a Macy's or a Dillard's or a Neiman Marcus or whatever. Yeah, Nordstrom, something like that. Okay, so you know how they have different departments and they're very clearly designated, right? Like you might walk in on the lower level floor and it's a men's department. It's got shoes, clothes, fragrances, ties, suits, whatever, right? Then you might go up a level and you've got women and juniors or something, right? They're very clearly defined. I can compare the performance of different departments within that same store. That would be intra-company. My second one is competitor, which is pretty straightforward, right? So Dillard's might look at the performance of Macy's and compare. So if I'm HEB and my goal in life is to drive Kroger out of business, that's who I'm paying attention to, and vice versa. Make sense? Okay, then I have industry-wide. So if I'm HEB in Stephenville, I don't have a Kroger to contend with, right? I only have a Walmart. Yeah? Have I made that up? I mean, we've built a lot of things and I don't go down that way, so it's possible that I don't know what we've built, but we don't have a Kroger, right?
Aldi.
Aldi. Okay, so here's the thing. HEB is not only looking at the competitor within their general vicinity, they're looking industry-wide at anyone who operates at the scale they operate at. So how does a grocery store determine its scale? How does anything determine its scale?
That'd be based on the net income.
Could be. I could look at my net income over a period and then I could say what stores do a similar level of net income. But then it begs the question, how do I know if I'm better or worse than them? What's an objective thing that has nothing to do with my strategy, right? It has nothing to do with my sales strategy, my marketing strategy, my pricing, my customers, my demographic, nothing. What's an objective thing about my store that might help me give a baseline for my comparison? Could be, but I pick those, right? So I pick my product mix, I pick my employees, I pick my prices.
How many customers are on the dog?
How many customers? Space. HEB, if it's 100,000 square feet, is not going to compare itself to a 300,000 foot Walmart. Does that make sense? It's not equivalent. So when they're comparing revenue, they can't compare because they have more space, thus they have more inventory, thus they sell more. So they're looking at industry-related competitors at a relatively similar size. then they're also paying attention to customer counts, demographic, to what they order, all the things that you mentioned. Still with me? Okay, final one for this one is guidelines. Anyone want to take a stab at that one? So in this class, there is no gap. Yay, that's exciting. There are no generally accepted accounting principles that have to be applied to managerial accounting statements. Why? Because they're not going to a shareholder. They're internal only in nature. So when I'm talking about guidelines, I'm not talking about reporting guidelines. That's sad. I thought that was going to help. You're like, no, it doesn't help at all.
Would that be according to like how the law dictates that they
Could
can
be.
operate?
Right, so there could be laws for how food service operates, right? So if you're a grocery store, the FDA matters, recalls matter, right? Guidelines for how you spell specific things, how you sell specific things matters. So the car industry is a great example. Different states have different laws about how titles have to transfer, right? So you have to stay within the guidelines, and you have to compare yourself to a business that also has to follow those guidelines. Because the more red tape you have, the harder it is to make profit. Make sense? That's why the U.S. Postal Service is the only entity to ever exist entirely in the red without ever having a profitable year, yet they get more employees and more budget every year. I'm bitter about it. We can talk about that later. Okay, so I've got 3 types of analysis we're going to talk about today, and we're just talking about the general sort of gist of it. I'm going to show you a couple examples. We'll do some more examples of these so that you can actually do the math. It's not hard math. So I had several people after Wednesday run up to me and say, I am not good at math. The good news is accounting is not math. It's got like some addition in it. Occasionally we do some multiplication. If we get really fancy, we'll divide something. But other than that, there's nothing really to it. Right? So all you have to do is understand the context of what you're looking for, and I'm going to give you the formula. So I've got horizontal, vertical, and ratio analysis. So I'm going to go through them one by one. We're not going to talk about them on this slide because I'm going to show you them. So if you haven't finished writing, it's okay. We're going to get there. Okay, so horizontal analysis is me reviewing financial data across time. Seems pretty straightforward, yeah? So when I say across time, what do you think that means?
For a fiscal year?
Okay, so from year to year generally, right? So I usually, and I can pull one up for you if you've never seen one, eventually I will, and I can do this today if you need to see it. But let's say that I look at Nike's 10K for this past year. It would have 2024, it would have 2023, and likely it would have a third year, 2022. Horizontal analysis is me doing this, comparing this number to this number to this number. And it's percent change or it's dollar change over time. What's the purpose of doing that? Why would I care about fiscal year to fiscal year? Right, it's the easiest way to tell what did I do last year, did it get better or did it get worse? The question then becomes, let's say that I had $500 million of revenue in 2023 and I have $200 million of revenue in 2024. Bad, right? Like off the cuff bad. I don't want my revenue to go down ever. But does that answer the question as to why it went down? So these are indicators of problems. They do not explain the problem. So when I do this, I'm looking for areas to explore. I'm not looking for the explanation of what actually is the problem. So here's what it would look like. So if I compare data across time within financial statements, I can do it a number of ways. The first way I can do it is called a dollar change. Literally exactly what it sounds like. How many dollars changed between the base period amount and the analysis period amount. So the analysis period refers to the financial statements under analysis. So if we were looking at 2024 as our year and saying how did we do in 2024, that would be my analysis period. My base period would be a period of my choice. So I can choose any base period I want. The good news is I'm going to tell you the base period on an exam. Right, so it's not going to be arbitrary. I'm going to tell you 2022 is the base year. Now compare it to 24, or whatever the case is. why might I want to pick a different base year than the previous year? So like the general conception with this is I say horizontal analysis and people say, so you're always comparing this year to the prior year. Maybe. I don't have to though. I can compare 2024 to 1990 if I wanted to. What would be the benefit of picking a different year versus just saying it's always the previous year?
Okay, so there's some economic, like COVID, you know.
2020 is a perfect example. Do I want to ever compare anything to 2020? No, because it was a blip, right? I mean, a blip that lasted forever. But financially, it was a blip, right? I can't explain why things happened the way they happened. So I'm not going to say I'm going to measure my performance based on COVID, right? Now, there are things within a COVID year, if you use COVID as your analysis period, that you would want to mimic, right? So stores found out that it was very important to have an online presence that was easy to use, right? Those who didn't suffer as much. Those who completely relied on a brick and mortar store where people had to walk in got screwed, right? So I can pick my base year. I am going to pick it for you on a test so there won't be any confusion. But you can pick your base year. If I want that same dollar change in percentage form, it's called percent change. I'm going to do the exact same thing. All right, so I'm going to back up really quick. If you look, I've got my analysis period amount and my base period amount. I'm going to do that in the numerator. Sorry, you want me to go back? Yes. I'm going to post these so you'll have them. Okay, so I have the same thing in the numerator. So in the numerator of this one, the percent change is my dollar change equation. I'm going to then divide it by my base period amount and multiply by 100. That is the same way you get percent change for anything. The same way you get a delta in stats. The same way you get, right, that's math. All we're doing is just plugging in financial data. Make sense so far? Okay. So let's try one. Can you see that okay? Somewhat? Maybe? Okay. So I want my dollar change between my current year and my prior years. My prior year is my base period. My current year is my analysis period. What's my dollar change? I love this part. When I ask for math and you all look at me like, I can't do math in my head, and you're all sitting there with a phone in front of you. I love it so much. And I just wait until people answer because I don't like to do math on a calculator. It's not fun. Oh, by the way, you can have a calculator for this class. I don't think I mentioned that on Wednesday. You can absolutely have a calculator. Don't do math by hand. Ever. Do what? Sure. Pick one. That sound good? So all she did was she took the analysis period year cash and subtracted the base period year. How much did the dollars change? So if you see, got 22,931. How did I get from 22,931 in the cash line to 88.5%? If I want my percent change, I did my dollar change here, right? So analysis period minus base period, which gave me 22,931, right? And what do I do here? Okay, which is 25,913. So if I take 22,931 divided by 25,913, I get 0.88 something times 100 gives me 88%. Does that make sense? Math is easy, right? Like the math is not bad. What makes this class bad is if you cannot figure out what it's asking you. That's why the context matters. The math has never been the problem. We good on this? You want to try another one? Trend analysis. same type of idea. I'm looking for a percentage, and I'm looking for the trend. What is a trend? Not an example of one, like a definition of one. A pattern, right? So if I take my analysis period amount and I divide it by my base period amount, what am I actually doing? It's kind of like finding a slope of a line, right? I'm looking for the change of one period over the other. And I'm looking for the trend or the line of best fit. So if I do it for multiple years over time, I'm going to see a trend develop. And to get it into percentage, anything into percent, I'm going to multiply by 100. So if I were going to look at my trend percent of net sales, let's say that 4 years ago is my base year, and the current year is my analysis period. What's my trend percent for net sales? Is it? I don't know, I haven't done that. How'd you do it? So the 260 of the current year and the 233 and change of the base year, right? She obviously, because the numerator is bigger than the denominator, got the number bigger than 1, right? And multiplied it and ended up with 111%. Does that sound right? Does that make sense? So I could do it all the way down. If I said that my 4 years was 100%, because my base year is always 100%. If you are inclined to like math, that probably makes sense to you. If it doesn't make sense to you, it's not going to harm you, so don't get confused by it. But my base year is always 100%, and then each year I'm comparing that total to this 100%. So my year 3, 215,639 is 92.3% of 233,000. Make sense? Easy? Cool. Okay, now let's talk about vertical analysis. So if horizontal analysis was over time, what's vertical analysis? I think it's only right that you know that I had a 2301 class on Wednesday where I gave extra credit for a kid doing a worm because they actually answer questions. Not that you want to do the worm, but like, you know, there is some benefit in interacting. And some of you have interacted very well. Others of you are just staring at me, which maybe will never change. But vertical analysis, anybody? Yeah.
Would it be comparing the base year to the net cost or other costs?
You're really close. So I'm going to do it all within 1 year. But I am going to compare to one item. So I'm going to pick a base amount instead of a base year. So here's what it looks like. I'm going to go back to the slide. Hang on. On a balance sheet, my base amount for vertical analysis is always total assets.
Okay.
So I'm going to compare everything on the balance sheet as a percentage of my total assets. That works because my assets equal my liabilities plus my equity. So at the end of the day, my assets are all encompassing. Does that make sense? So I'm going to look at different numbers and I'm going to say what percentage of my total assets is made up by accounts payable. What does that tell me? It tells me the portion of what I have versus what I owe. It tells me, am I over leveraged? On an income statement, the base amount is always net sales or total revenue. So I'm gonna compare everything on an income statement to my total revenue, meaning what portion of my cost of goods sold makes up my total revenue. What does that tell me? Are my costs too high? Right? So I might have an internal threshold that says my cost of goods sold cannot exceed 55% of my total revenue. I would only know it if I compare it every year. Does that make sense? So here's one type of vertical analysis. It's called a common size percent, which is what I was just talking about, but here's how the math works. My common size percent is my analysis amount divided by my base amount. So if I use a balance sheet, again, base amount's total assets. If I use an income statement, base amount's total revenues. Always. So there's never going to be a different base amount. So anytime you're asked for a common size statement, if it says it or if it doesn't, this is always the rule. Cool? Bless you. Okay, we good on this? Can I move it? Okay, so try one for me. So tell me what portion of cash and cash equivalents in comparison to my base amount.
I was making things up. Do none of these work, really?
Okay, so back to the question. That was depressing. You know how to do it? How do I do it?
Cash and cash.
Cash by total assets.
Okay.
Multiply by revenue.
All good? For those of you that actually did the math, that look right? Okay, so you took your analysis period divided by your base period, or your base amount, right, in this case. Perfect. So, every time this happens, the same thing as your base year being 100%, if that makes sense to you, pay attention. If it didn't, it's okay. If that made sense to you, then whatever your base amount is in your statement, total assets or total revenues, that's 100% now. So everything is listed or described in comparison to that 100%. You with me? Okay, last thing, ratio analysis. So we are going to cover this semi-briefly. It is important, you're gonna get it in a finance class, so if it sort of makes sense to you now, particularly those of you who are finance majors, this will matter, because ratios are like your whole life from now on. For real, they are. They're very helpful. Actually, they're very helpful in marketing as well. So if you know, if you're good at ratio analysis, you're a better marketer. So my ratio analysis, basically a ratio is a measurement of key relations between financial items. So a ratio literally is one item divided by another, right? So I'm just comparing one to another in the form of a division problem. So there are 4 types. You recognize these terms? Okay, So my vertical and horizontal analysis were within my statements and across my statements over time for the purpose of these four things. Just like the ratios fall into these four categories. So I've got liquidity, efficiency, solvency, profitability, market prospects. So if you still have no idea what I'm talking about here, now would be the time to stop me. Okay, so liquidity and efficiency ratios, we're gonna talk about four of them. These are not the only four there are. These are just the four that are the biggest for right now. I have my current ratio, and I'm gonna show you the formulas for all of them, so it's okay. I've got my current, my accounts receivable, my inventory, and my total asset turnover. So as you'll notice, everything name-wise on here is an account that's on what financial statement? The balance sheet, right? So liquidity and efficiency are always functions of your balance sheet items. Always. Okay, they're gonna come up. If you didn't get the list, they're gonna come up individually. So, my current ratio is my current assets divided by my current liabilities. So I have up here what it tells you, because generally this part of the conversation gets very dry for me, because I just sort of wait while people look at me, and you've never seen them before generally, so it's really not fair. So this measures my short-term debt paying ability, which makes sense, because if I'm current, I am liquid, or vice versa. If I'm liquid, I'm current, right? When you do this ratio calculation, the higher the number is, the more likely I am to be able to meet a current obligation. So if I have a current ratio of 1 versus another company with a current ratio of 4, which one's more likely to meet their short-term debt? The one with the ratio of 4. Good? Okay, my accounts receivable turnover is exactly what it sounds like. How often do I turn it over? So when I'm talking about, let's use, what's the turnover in football? Basketball, soccer, any sport, what's the turnover?
Give the ball to the other team.
You flip it, right? That's literally what's happening here. So a turnover is when I flip an account receivable to cash. So this ratio measures how many times I convert my receivable to cash, how many times I turn it over. Does that make sense? Same thing with inventory. There's an inventory turnover ratio. How many times do I turn the inventory? Do I sell it? So I'm going to take my net sales and I'm going to divide it by my average accounts receivable, the net amount. So for some of you, it's been a little longer than a semester since you've been in 2301. So somebody remind me what the net amount of accounts receivable is. Because I put net on there, so it's important. But do you know what I mean when I put net on here? And what? Minus uncollectible accounts, right? So perfect. So all my accounts receivable, all accounts receivables, netted with anything I know I'm not going to collect. Okay, so my inventory turnover is similar to asset turnover. How many times do I change or convert my inventory to cash? So this measures specifically how long I hold inventory before I sell it. Why would this be a very helpful piece of information for you? Right, so one, it helps me order, right? So if H-E-B knows that a particular brand of something sells faster, they're likely to order more of that instead of the one that sits on the shelf, yeah? I'll give you an example of a company that didn't pay attention to inventory turnover. You ever been in a Bed Bath & Beyond? And they had a comforter from like 1992 also didn't move inventory? Toys R Us. You know who moves inventory very quickly? Bucks. Make sense? So if I know how quickly I sell something, I know how much of it I have to have on hand. If I know that it doesn't sell very quickly, I'm not gonna order as many. If I find out it doesn't sell at all, I'm gonna stop ordering entirely. This will help me with that. Okay, last one in this section, total asset turnover. So, the purpose of my asset is it's something that I have, right? And it's something that I have the right to use to generate revenue. So, there is a direct correlation between the assets that I have and the revenue that I generate. So, in this class, revenue and sales are synonymous terms. So if I say net sales or net revenue, I'm talking about the same thing. I'm talking about units times price. So if I'm a t-shirt seller and I sell t-shirts for $10 and I sell 10 t-shirts, right? Units times price gives me total revenue or total sales. So this one measures my ability to use my assets to generate revenue or sales. If I have a bad asset turnover ratio, what does it suggest about my assets? Okay, so it could be that I have an inventory asset that doesn't sell. What else could be true? Yeah. Could be. Yeah, so that could indicate if I'm not generating sales from my assets, it could indicate that something's wrong with my sales structure, right? Like I'm priced too high. What would it indicate about my assets though? Think about a company that uses a lot of computer software.
Indication of operating efficiency?
Okay, so how well I operate. So think about a company that has a lot of computer software. What happens every several years? It's obsolete, right? So at some point, if I don't keep investing in my assets, they'll stop generating revenue for me. If I have a factory that uses screen printing, that relies on a computer, and I have 4 computers that run DOS, what's my asset ratio look like? Nothing, right? That computer does nothing. Does that make sense? So it tells me, 1, is my pricing structure right? Is my sales structure right? And it tells me, 2, do I have the right assets? Do I need additional assets? If I'm a farmer, this would help me decide whether to buy an additional piece of equipment or a bigger piece of equipment. Does that make sense? Okay, solvency ratios. I've got debt to equity, and times interest. Okay, so I'm gonna move past this one because I'm gonna show them to you individually. So my debt ratio. All I'm doing in my debt ratio is showing my total liabilities as a percent of my total assets. And it literally tells me the ratio I have of debt to everything I have. So I don't know if I did this on Wednesday, but if I look at the accounting equation, instead of an equation in the form of a circle, did I do this? Probably not. Okay, so everything in the circle is an asset. It's all stuff that I have. So if I'm an individual person, it could be a house, a car, a piece of land, a truck, a piece of equipment, a horse. So we'll write like anything could go in here. If I'm a business, it could be land, buildings, inventory, you name it. Everything in the circle is an asset. The portion of the assets that I own are equity, right? I have an internal claim to that asset. So if I've paid off my house, the entirety of the value of the house asset goes in here. The portion that I don't own, that I owe, goes in my liability section. It's a creditor's claim on what I have. Does that make sense? So this debt ratio is me saying, this is the portion to everything I have that's made up of somebody else's money. What does it tell me? So earlier I mentioned that I would always, almost always, want to spend somebody else's money instead of mine. So debt's not bad in a business, right? Like, it's not bad. What does this ratio tell me?
How much of it you own?
Okay, so it tells me how big is my debt in comparison to everything I have, right? So generally, how do you get debt? How do you borrow money? very nicely. Yes. You get a loan, right? How do you get a loan?
Through a bank?
With a credit score.
Oh.
What does your credit score tell people?
You can try it.
How likely you are to pay, right? Your liquidity as a person, your solvency as a person. What do you do if you want something really big and you don't really have the credit to underwrite it?
Take
Interest rate.
You might take a higher interest rate to cover the risk, right?
Get a co-sign.
You would put collateral up against it, right? So this ratio tells me if I have a bunch of debt and this little piece of my circle is getting smaller and smaller and smaller, how likely is it that these people will come for what I have? Does that make sense? So if I don't have the right assets, if my asset turnover ratio, if I'm not generating enough revenue from these, if that's not good, then my debt ratio is gonna tell me how quickly will these people come to take my assets because I don't use them well. You with me? Okay, then I have my equity ratio. Same idea. I'm gonna compare my total equity. We're gonna restore my equity. I'm gonna compare my total equity with everything I have. So what portion of all the assets that generate revenue for me, ideally, do I actually own? There's no formula for this because you're literally taking the number that says total equity and dividing it by the total assets, right? Like, there's no formula for it. You're just comparing the numbers. Because where you are gonna do the formula is this one. So if I know my total debt to my total assets and my total equity to my total assets, if I put them together, I'm gonna take my total liabilities divided by my total equity, and that's gonna tell me the portion, percentage-wise, of my company that was contributed to me by somebody other than me, i.e. owned by somebody other than me. So here's where it gets a little confusing for people. Actually, tell me when you're done writing it, and I'll tell you. So just look up when you're done. We good? Okay, so here's where it gets a little confusing for people. So that is the accounting equation, right, in the circle. You normally have seen it like this. It's the same thing. Everything within the circle makes up the circle, right? It's the same thing. What is this portion made up of? So this is loans, right? Or bonds. What's this? Okay, so it is retained earnings, right? So retained earnings is a portion of it. I'm gonna put it down here. That happens later. Where I got retained earnings is he said revenues minus expenses gives me net income. Net income that goes from period to period is retained earnings. Stock, right? So when I say that debt to equity tells me the portion of my business that was contributed by somebody else, I mean external to the business. So there can be more than, in addition, there can be more than one stockholder, right? It could be me, one stockholder. Then it can be 1 million employees as shareholders, but we are internal. So we're all equity. Does that make sense? All owners are equity. These are creditors. So this ratio tells me what portion of my assets were contributed by this group of people. People who don't have ownership but loaned me money. Does that make sense? Okay, and then times interest earned. This one's important because if you're paying attention to debt, all debt generally comes with interest, right? Like, there are very few scenarios where you get interest-free financing. And even if you do, it doesn't last the entirety of the loan generally. So businesses will borrow, and they'll borrow to have operating cash, right? So they'll borrow money to have liquidity so that they can pay immediately, or they can invest into assets that will then generate them income. The catch though is that they then have to pay the interest on that lump sum until they pay it off. Right, so my times interest earned tells me a company's ability to pay their interest expense. If I can't pay my interest expense, what does that suggest about me as a company? So if Lane's my creditor, how much you want to loan me, Lane? Think big.
500K.
I said think big and 500K is what you, okay, sure. He loans me 500K. What do you think my interest payment on 500K is? Lane's a loan shark, so let's say we did 12%. Let's say we did 10%, because that's easier math. What's my interest payment? It's just simple interest on 500K.
It's 50,000, right?
Okay, 50,000 sound right to everybody? It's 5 with some amount of zeros? Okay, so if I can't pay my 50,000 of interest every month or every year, whatever the rate is, right? Whatever the corresponding agreement contractually is, what does that suggest about the 500K?
You won't get it back.
You're probably not gonna get it back, right? So then what does he do? If he was smart, he asked me for collateral, right? He asked me to securitize that loan. So he'll come and get a piece of equipment, or he'll come and take my house, or whatever it is. If he did it, what does he do? Do it. He could try to take an asset, but if he has no contractual right to do that, if there's no collateral, and I can't pay my interest, thus I cannot pay my loan, what now?
Would that be a bad debts expense?
I mean, for me it wouldn't be, for him maybe. Does he want to write off 500K? What does he do?
Sends it to a debt collector.
He sells it, right? And then somebody comes after me for more, right? So this is going to tell me something similar to my debt to equity ratio. How quickly are people going to come after my stuff? So with me? Okay, so we're going to cover profitability when we get back. I'm going to be done for today. If you have questions, let me know.
Damn, what's going on?
I didn't understand that one map.
Yeah.
It's a lot better than my last one.
Yeah, me too.
What did you have last?
It was a dude. I can't remember his name. Adams?
Cornell.
Oh, yeah.
She
She gives a lot of work, right?